In fact, this number could be far larger than anyone ever expects, or it could be somewhat less than what most people expect. I tend to believe it's the latter. I believe it's a lot larger than most people expect. And that there is no particular exchange that trades these markets. There's also no centralized gathering information. So a lot of people who like to trade on volume or open interest or like to focus on price solely are handicapped when it comes to trading the OTC market because they just don't have that type of data available to them. Lastly, there are interest charges for holding positions too long. As I said before, when you trade the spot or cash market, you are actually putting yourself in a position to buy or sell the actual currency. So you are in the cash market as if you were a bank or an importer or an exporter. And when you're in the cash position, you actually have to borrow the money, both currencies, and you're on the hook for that. It's sort of like when you decide to borrow on margin against stocks in your stock account. If you decide to trade on margin, which is typically about 50%, you are forced to pay an interest fee to the brokerage firm to do so. Well, it's the same scenario. You have to pay an interest fee to the bank. This has a positive side. When you're buying one currency and you're selling another currency, you actually are receiving interest for one currency and paying interest for another currency. And so the difference between the two kind of mitigate the amount of interest that you have to pay overall. Sometimes you're at a profit, but 90% of the time you're actually at a loss. And so the interest rate is a bad side to trading foreign exchange currencies. And then last is the price knowledge is limited to your dealer. With the advent of so many dealers on the marketplace, independent, Alaron Forex is a company that we work with, but there's Owanda Forex, there's many other smaller dealers out there like them. You have to basically rely on your dealer providing you the best prices possible. And many dealers are not out there providing the best price possible because they make profits off of not doing so. As I said before, there are no overt commissions in trading, over-the-counter Forex trading, but there are hidden commissions, and that's typically in the bid-ask spread. So if you want to buy European currencies and you have 120, the price is 125 bid and 120 ask, that difference in price is actually the commission that you have to pay. And unfortunately, you have to pay that on every single trade. So it's something to think about when you're trading Forex. And again, when your pricing is limited to the dealer that you're working with, you really don't know if you're getting the best deal. So it makes it more and more difficult to negotiate. So it's good to have maybe one or two OTC Forex accounts in order to get the best possible deal. Now we'll look at the exchange traded markets, and we'll cover the exact same ground. We'll look at who the players are, what and how they trade, and then the advantages and disadvantages of trading the exchange traded markets. Well, nothing's changed since the last seminar. In the futures market, there are only two players. There are the hedgers and the speculators. It's a little bit different from the Forex market, which have the hedgers, the speculators, and then the bankers, but similar dynamics. The hedgers are the banks and the dealers that carry cash positions in the interbank market, and then they'll use the futures contracts to protect themselves in the OTC market in case things go wrong. And this is a common practice by all banks because they're required to have diminished risk. A lot of them are FDIC insured or equivalently insured in their countries. So they need the futures market in order to protect their cash positions that they may be handing out to someone like you or myself in the OTC market. And then there's the speculators. And as always, the speculators are there to profit from the price movement of all the hedgers. They provide the liquidity that the exchanges need to trade foreign exchange market, and you and I sometimes are the cannon fodder and sometimes are the victors when we're operating as the speculators for the exchange traded markets. Now, there are a lot of different types of exchanges trading Forex. Some of them are commodity exchanges, and at least one of them is actually a stock exchange. And we'll cover the first two. The Chicago Mercantile Exchange actually was the #1 pioneer of foreign exchange in America, if not worldwide. They were the first ones to set up shop the moment the Bretton Woods Agreement was disbanded back in 1971. They opened their doors in 1972, and they've created a myriad of products on currency trading. They also offer mini currency trading, which is known as the E-minis, particularly on the Japanese yen and the euro currency. Almost a decade later, I guess a little over a decade later, we see that other people begin to jump on the bandwagon. We see the New York Board of Trade started the Finax division, which started what I believe, and what many people believe, is one of the most monumental changes in foreign exchange. They created in 1985 what was known as the U.S. Dollar Index. The U.S. Dollar Index was a basket of a basket of currencies worldwide lumped together to give us a view of how other countries are viewing this actual and true strength of the U.S. dollar. Great indicator of what's happening in other countries, and also trying to figure out where other countries' currencies are heading. Great indicator. And then lastly, we have a stock exchange which jumped into the currency movement, again, about a decade after the Chicago Mercantile Exchange. And what they set up were what were known as currency options. They're the first widely held exchange-traded currency options that were customized. This is an entirely new view on how currency options were traded. It gave those people who were trading in the OTC market more opportunities to protect themselves. And since these were just G7 countries, and as we saw earlier in the OTC market, it's only G7, or 80% of all trades are G7 countries, it gave definitely a large group of people the opportunity to trade currency options and customize them with an exchange to have fixed prices, as opposed to simply relying on the OTC derivatives market to give them good pricing. We'll briefly look at some of the history of the Chicago Mercantile Exchange and their development. As I said before, they were the first exchange to bring currencies to the marketplace. They set up shop immediately after the Bretton Woods Agreement in 1972. But they also have the unique distinction of also being the first exchange of bringing financial futures to the marketplace. Because of their creation of futures contracts on the U.S. dollar at the time, the Deutsche Mark, and many other currencies, they set the precursor precedents for what was happening with the S&P index and what's happening with the NASDAQ index now, which a lot of you do like to trade. On May 16th of 1972, the first 7 currency futures contracts that were listed were the British pound, the Canadian dollar, Deutsche Mark, French francs, Japanese yen, Mexican pesos, and Swiss francs. Later on, we saw the Mexican peso actually fall off of that list, and only recently being reinstalled over the last 10 years. In April of 2001, the CME tried to do a second move. They decided to be the first exchange-traded market that offered Forex trading on a 24-hour basis. And they created an electronic market which ran simultaneous to what was happening in the pits in the exchange-traded market, and this market was known as the Globex. This electronic market is known as the Globex. And so far, whether attempts at creating the Globex have been valiant, many people still prefer to trade the OTC market during the off hours of the exchange-traded market. So still 90% of the volume in the CME is happening during the day, during the 7 a.m. To 2 p.m. time frame that currency exchange does in Chicago time. But it was a great attempt by the CME, and I believe over time, as more and more people begin to trade in the OTC market and see the benefits of using futures with the OTC market, it'll probably start catching up and gaining more speed.